Hello everyone, greeting to all the students. So, welcoming you to the Global Online, and here we are back with our target of 1000 plus MCQ series, and we this is the part 17, and we have already completed over here the 1000 MCQ series, and we are back with our plus 1000 MCQ series, and here we are going with our business finance and financial management unit. Okay, and here we are going to discuss the most expected and most repetitive question which I have ever seen in this question paper, with our in-depth explanation of all these questions and with a detailed explanation. Okay, so I'm Dr. Swati over here. I'm welcoming you to the Global Online. uh, I will quickly tell you about the Global Online. Okay, before we go ahead, so here the comprehensive course of the commerce and management is going to be provided here over here. Daily live lectures is provided and the recorded is also available. Complete syllabus note in the PDF format is available. Full syllabus mock test, more than 4000 MCQ series with detailed explanation. PYQs with detailed explanation. If you register yourself for the paper 2, that is commerce or management or the management, so here you will get paper 1 is free of cost for you. And Global Online provide you the 50% discounts on the fees. Okay, and here you know that the new batch will be our new batch will be going to be started from the 8th of the July, and every Monday we launch a new batch for your better better facility, and the WhatsApp contact number is given in your screen, so get in touch with this contact number for more detail. So how to download the Global Online? So go to Google Play Store, just download it, register with your number, go to My Course and select the whatever the course do you want. Once you selected, you can see that the interface of the app is actually looking like this, and here you can see the unit wise folder is available, recorded lectures is also available, unit test is available, and the mock test is available, materials is available over here. So yes, just join it as early as possible because you have a very less time to prepare. Now you can see the first question which is in your screen. Let's start with our question. So first question which is given in your screen, that is a matching question. So the for list one is given, that is NI model, NOI model, traditional hypothesis, hypothesis, and the relation of this model and this hypothesis, and the relation, what is the relation of this model with the cost of equity, that is KE. Okay, okay. So here let's try with yourself this kind of question. Just pause it, try it with yourself. I will be there for you. Okay, so let's understand the concept first, then I will go with it. Okay, so here you can see in the traditional approach, of the capital structuring, you have seen that there is if your KD is increasing, so your KE is also going to be increases. Because what is happening over here, if you're increasing if you're choosing your cost of debt, okay, for the financing, so what is happened here, there is a risk of bankruptcy is going to be increases. And if your KDs arises high level of a gearing due to the bankruptcy risks is over here. And what has happened, that is a KE increasing as a gearing, increasing the rising of the finance risks and the later the bankruptcy. Okay, so in the simplest word, I can tell you, that is, if you are increasing your KD, so there is a chance of, that is KE, that is cost equity. Equity shareholders say that they also increasing their value. Okay, so they are also demanding more because the debt are increasing, so the risks of the K is also going to be increases, because if you're financing from the debt, so the fixed rate of interest is the priority of giving the interest rate is going to be increases. So there is a chance of there's a risk to the equity shareholder. If your equity shareholder demanding more, so what happened? The overall cost of capital is also going to be increases. Okay, there's also going to be increases in the, okay. That's why if your WACC is going to be increases, your your cost of capital going to be increases, and it is adversely affect to the value of the firm. Okay, so it is value of the firm going to be decreases. So this is a concept of the traditional concept. Now let's understand what is the NOI approach. So in the NOI approach, if here you can see your cost of debt is a constant. If your cost of debt is constant, will be no effect on the cost of capital. Okay, but your cost of equity going to be increases over here. So the proportion of the debt increases, that is increases, K is also increases. If you are increasing your debt, so the K is also going to be increases. Okay, okay, over here. Now, what is NI approach? In the NI approach, you can see there is a cost of equity is constant for all leverage, because if what is the NI approach? NI approach say there is a cost of debt is the cost of debt, and the cost of equity is a constant, because cost of equity shareholder not they do not want to make a difficulty in their business. So they're constant. They do not get affected with any kind of leverages if you're doing. Okay, so what has happened, your cost of, if you're financing more with the debt, if you're using more debt, so what has happened over here, the gradually your cost of capital going to be decreases. So this is a NI approach, that is NI model. So A is matched with 3. Okay, so option number A and option number D going to be cancelled over here. Now, what is hypothesis? If you correctly match this, you can easily answer this. Okay. So, what is hypothesis? So, hypothesis is say that if your cost of equity increases rapidly under the extreme level, or either there is a two chance, or that the cost of equity decreases under the extreme leveraged. Okay. So, NOI approach, there is an what in the NOI approach? The NOI approach is say that if your uh mm, no, in the leverage is also going to be increases. Yes, so in the NOI approach, you can see there is a, if your cost of equity is increases, so the leverage is also increasing. That means if your cost of debt is this, so if your cost of equity is increases, what they are doing? They are increasing the cost of equity. So what is happening? Your WACC is also going to be increases over here. NOI approach. Here you can see this is KE increasing, cost of equity is constant, debt is on square. But if the equity is increases, so what is happening? It's adversely affect, debt is increasing and K is increasing. So they both are increasing. That means here it's also there is a leverage is also increasing, because debt is increasing. Okay, so here is 2. Now, the what is the traditional hypothesis? One, the traditional hypothesis, what we had seen, the cost of equity increases with the rapid under the extreme leverage, or cost of equity decreases with the extreme of the leverage. So here the cost of equity decreases, okay, with under the extreme leverage. It is said by the traditional approach, and approach said the cost of equity increases rapidly under the extreme leveraged. Okay, just give me a second. Yes, so the option number B is right over here. Okay, B is right over here. Now, the next question, that is the discount rate at which the net present value of the project become 0 is known as. So here the average rate of return Option number B, internal rate of return, alternate rate of return, or none of the above. So what will be the right answer over here? You can see that discount rate. Okay, just pause it, try it with yourself. Okay, first of all, and in the discount rate at which the net present value of project becomes zero. Okay, so if you want to hear that is your net present value is want to be a zero, so what you have to do, just you have to do that what either you have to do, that is, what is the formula? When your present value of the cash inflow is equals to your present value of cash outflow, okay, and the present value of cash inflow having the relationship with the present value of cash inflow, in the it is having a relation with your IR, internal rate of return. When the both two things are going to be equal, then the NPV is going to be zero. Okay, so these all happen in it's under the internal rate of return. Okay, so here you can see uh, okay, here you can see there is a formula, that is, if your NPV is greater than 0, so just accept it. If your NPV is less than 0, so reject it. If your NPV is equals to 0, so either you accept it or either you reject it. So it's depend upon the whatever the project we have choosing. Now the present value of the present values formula is net present value formula is present value of cash inflow minus present value of cash out, sorry, present value of, okay, cash inflow divided by present value of cash outflow. Okay, so here this is a formula, this is a basic formula. Okay, and this formula is going to be explained in this formula. Just look at, just once you have to look out. Okay, and here now you are saying the IIR. Okay, IIR having the lower the rate is related with your NPV. Okay, so the IIR is related to your NPV, net present value, and here the lower rate, okay, NPV lower rate plus NPV higher rate, whatever the higher rate, and then the difference of the lower and higher going to be multiplied in this formula. Okay, now the next question, that is the portfolio theory. Portfolio theory articulate the diversification to reduce which of the following risk. Okay. So here the market risk, financial risk, unsystematic risk, or the business risk. So here you can see that is the portfolio theory articulate the diversification to reduce which one. So the portfolio, it's let's understand the things, that is first thing, the risk having the two, because it's talking about the risk, so systematic risks and unsystematic risk. In what happened in the systematic risk, there is a market risk, interest risk, and the purchase power risk. In the unsystematic risk, which you can controlled it, okay, and it is having the have the micro in nature, and the systematic risk is uncontrollable because it is a systematic, okay, and it is having the macro in nature. Okay, there is a macro in nature. In the unsystematic risk, there is a business risk, internal risk, external risk, financial risk. Okay, now, so what is it? In the portfolio theory, articulated diversification to reduce. So reduce which actually the why we portfolio we used. Portfolios used to reduce which things we can reduce it, which is in our control. Okay, so the systematic risk is uncontrollable, and in the systematic risk you have seen that there is a market risk is a systematic risk. Okay, financial risk is an unsystematic risk. Okay, this is an unsystematic, and business is also unsystematic risk. So In the due to portfolio, we can diversify, we can reduce our risk. Okay, because in the the things which we can control, which we have in our hand. Okay, so this, what is the kind of this risk? So basically, what we risk we have a systematic risk or we have unsystematic risk. So from the option we have to choose the best option. So for this best option, we having the option that is a unsystematic risk, because we can control it. Okay, and the portfolio having that articulate to reduce the risk. Okay, because the systematic risk is fixed, you can't change it, this is a static in nature. Okay, but in the systematic risk there is a diversifiable, they can diversifiable. So that's why the systematic unsystematic risk is having the, there is a diversifiability. Okay, there is a diversifiability, and there is there in the unsystematic risk. Okay, yes. Now the next question. So here you can see, I will there is an and what is that diversity, that is a portfolio. So we are in this slide, we're talking about the portfolio. So in the portfolio we are just talking in the portfolio means what? Portfolio which is related to your derivative market participants. Okay, in the derivative there is a hedger, there is a speculator, and there is a arbitrator. Hedger, the persons who do not want to take a risk. Speculator, who want to take a risk. Okay, they are ready for the taking the risk. Okay, but the what arbitrages, they, what they are doing, they are smarter. What they are doing, they're purchasing from the one site, and they sell from the another to the another. From the one company, they purchase from the one company, they just want to balance it. Okay, so there's an arbitraging person who simultaneously sell or purchase the same financial instruments in the different market, in order to make a risk less make a risk and less profit. So these are the arbitrators. Okay, now the next question which is in your screen, that is, a profit is the profit is a product of. So, and the profit is a product of what? Option is given: total sale value multiplied by PV ratio, break even point sale value multiplied by PV ratio, margin of safety, sales value multiplied by PV ratio, and none of the above. So you know that how do you calculate? We have just say that this is a break even point, and from the break even point till this point there is a profit. Okay, this area is a profit. So you can see that is the profit having the relation with the margin of safety. Yes, ma'am, there is a relation, but they also having the relation, and profit having the relation with their PV ratio. Yes, and how do we calculate our PV ratio? How do we calculate from the sale? When we reduce our variable cost, and when we contribution divided by sale. Clear? So this is a PV ratio. Clear? So there is a contribution divided by sale multiplied by 100. This is a PV ratio. So what is the margin of safety? Margin of safety, that means from the total cost, when we reduce our total revenue. Okay, or yeah, either you can say this is a profit, but what you are doing from this break even point, and from this break even point to this total sale. So whatever the difference we were taking, this is a margin of safety. That means from the total sale, when you're reducing a sale at a point of break even point, so that is your margin of safety. And when we are calculating that margin of safety, you need a profit. You need a PV ratio. So the margin of safety having the formula of the profit divided by the PV ratio. Now, this is a margin of safety formula, but the question is about the profit, ma'am. So, what is it? So, here you can see that when we are just what I want a profit. So, what can I do? I do margin of safety multiplied by PV ratio is equals to profit, isn't it? So, what formula is going to describe it? Margin of safety sales value multiplied by PV ratio. So, the option number C is right over here. So the total sale multiplied by PV ratio, this is absolutely wrong. This is, and the break-even point of the sale multiplied by PV ratio. No, this is also going to be wrong. So option number C is right over here. Clear? Now the next question, just read it with yourself and try it with yourself. Okay. Now I'm just giving the. So the option list 1 and list 2 is given to you. In the list 1, there is some ratio is given. There is a return on investment, acid test ratio, debt equity ratio, inventory turnover ratio, and the relation with the analysis of all this ratio. So, the simplest one, that the inventory, how the inventory turnover is related to your activity. Yes, so option number 2 is right. So this one going to be cancelled, this one going to be cancelled. Now, debt equity ratio this a ratio of is used to use for the long term solvency. Yes, so C having the 4. So option number D is right over here. Okay, and the acid ratio is related to your liquidity ratio, and the return on investment, it is nothing but your return on capital employed. Okay, so this is your, no, yes, this is your profitability ratio. Clear? Yes. So here you can see there is an accounting ratio. Accounting ratios are further categorized with the types of the that is a liquidity ratio, leverage ratio, activity ratio, and the profitability ratio. So in the liquidity ratio, you can see there is a current ratio, cash ratio, and the quick ratio. So this liquidity, that means how much liquidity you have in your hands. Okay, that is the liquidity. Actually liquidity show your liquidity, that's your money, that is your current ratio. Okay, that is current ratio, current asset divided by current liability. Quick ratio, current asset from when we deduct our stock and the prepaid expenses. So and divided by the current liability. So this is your quick ratio. Okay, then the cash ratio, yes, it is simplest. Yes. Now the leverage. So the leverage, it is your, yes, I have already told you in the last lecture, that is a leverage. It is your, it's related to your debt and equity ratio, because leverage show the relation of your debt with your equity and with your cost of capital. Okay, so this is a cost of equity ratio. If this actually leverage show the relation of the debt, how much debt you have as per the as compare with your equity. Okay, and what is a debt to asset ratio, how much debt you have according to your asset. Then the interest coverage ratio, how much, if you're taking the debts, you have to pay, you have to pay, you have to need to pay the interest. So in the either this interest is going to be coverage or not. So this ratio actually show this thing. So this is a leverage ratio. Now the activity ratio. Activity means any activity which is related to your inventory turnover, which is related to your receivable turnover, which is related to your payable turnover, or the fixed asset turnover. So the whenever the turnover word you have seen, so it is nothing but it is your activity. Okay, then what is the profitability? So profitability, you can calculate a profit by with the gross profit margin, either you the operating profit margin, either by the net profit, either by the return on capital investment. So these are the formula which is really important. They can ask a question from this area, and the many times they ask a question from this area. Okay, so now the next question which is in your screen, the phenomena of over trading in working capital is categorized by. Option number A less amount of the cash invested in a current asset, overcapitalization of the company as a compared to the volume of the sale. Third option, that is high amount of the cash invested in current asset, and the all of the above. Okay, all of the above. So, just try this question with yourself. The question is talking about the phenomena of the over trading, and over trading in what? In the working capital. Okay, so over trading in the working capital, actually this is what, this is a here you can say the less amount of cash is invested in the current asset. That means you're doing over trading. That means you're not investing too much in the you're not saving your working capital. You're not saved your current asset. You're doing over trading, and if you're doing the over trading, so you, that means so you're wasting your current asset. You're not focusing your current asset. You're not investing in your current asset. You're reducing your investment in the current asset. So this is option number one. So let's understand this concept first. Okay, what is the over trading? What is the over capitalization? This word is also going to be used in this concept. So let's understand. So here you can see the working capital management is a key factor of the organization in the long term success. Okay, if you're managing your working capital, so if you're today managing your working capital, it is going to be long term success in the future of to the organization. Now the balancing the profitability and the liquidity. Okay, okay, where if you see when you are seeing your aggressive, okay, which I have already, that in the aggressive working capital you have seen there is an a profitability profitability is high, but your liquidity is going to be decreases. What is about in the conservative means there is a profitability is decreases, but your liquidity is high. But what is in moderate? So moderate in the your profitability is moderate is equal is plus, and your liquidity is also equal. So this is a moderate. So here that's why they are talking about the profitability and the liquidity. They going they in the working capital you can see they giving the focus to the profitability and the liquidity. How much profitable you are, how much liquidity you have. So these are the question. Now the decision regarding the level of the overall investment in the working capital is a cost and benefit trade-off, liquidity versus and the profitability. Now what is the over capitalization and over trading? First of all, you need to understand the overcapitalization. If any excessive inventory, okay, any excessive inventory, okay, either cost receivable or the cash or very few account payable, there will be and the over investment by the company in the current asset. That means you are over capitalizing. That means your inventory is in current asset is what it is, your current inventory is what it is your. That means if your current asset is increasing in a very short period of time, or it is going to be over because you're storing more inventory, you're increasing your receivables, you're you're reducing your payables. So this that's why your current asset is increasing. So it what you are doing over here, what the company is doing over here, they're doing your over exercising, overlapping or over capitalizing the over capitalizing concept. On here what working capital is excessive, and the company will be over capitalized. If your working capital is, if your current asset is increases, there you know that there is a direct relation of the working capital with the current asset. If your current asset increasing, your working capital is increasing. If your current asset decreasing, your working capital decreasing. Yes. So if your working capital is excessive, the company will be over capitalized. Why over capitalized? Because current asset is increasing over here. That's why the working capital is also increasing. So what is going over here? The over capitalization. Now, what is the over trading? So, in the over trading, you can say the flow of the either you can say the cash flow of the lifeblood of the travels of the business. The effective management of the working capital investment are essential to maintain and control of the business flow. The management must have full awareness of the profitability versus the liquidity of the trade off. Okay, now in the over trading you can see that the business does not have access of the sufficient capital and the fund to fund the increase. It's said to be over trading. That means they are doing over trading. They do not have a and they do not have a much current asset in their hands. They do not have their much working capital in their hand. Because what they do over trading. They're just they're not the so what is over here over trading? Over trading, the in the simplest way, over trading means when your working capital is decreasing, working capital is less. If your working capital is less, that means your current asset is less. Yes, that's why the over trading means what? In the simplest word, working capital is less. That's why the current asset is less. So that's why the less amount of cash invested in the current asset. Clear? Now the next question, which is the sequence of the following in the capital budgeting is process. So the sequence is given, that is the first, the cash flow estimation, identify discounting rate, project selection decision, determination of the NPV. Okay, this is not okay. This is a full stop. Okay, so the correct choose the correct answer from the option. Okay, so here is talking about the capital budgeting process. So what is a capital budgeting? Just try it with yourself. Okay. So what is a capital budgeting? So capital budgeting is a process of evaluating, estimate and huge expenses in order to gain the best return on the investment. That is, whatever the capital you have structured, whatever the capital you have financed, whatever the capital you have collected from the your debtors, your equity, from your retained earning. So that capital you have to budget it, you have to manage it. So what you have to do, you just use the return on investment when you get the return. Okay, so it is included in the decision to investment in the current fund of the additional modification, disposition and the replacement of the fixed asset. The capital budgeting process sequence is, first sequence is cash flow estimation. First thing what you have to do for budgeting, how much cash flow estimation which is have. Okay, so used to determine the economic viability in the long term investment. Then B, identifying the discounting rate. Okay, so the discount rate is a rate of the discount to the discount future of the cash flow bank to their present value. A discount rate is the expenses to change in the value of the money in the investment in the business over a period of time, and many company calculate the WACC, overall cost of capital, and use it as a discount rate when the budget is for the new project. So what is the first thing is what a cash flow estimation. The next one, that is identification of the discount rate, how much discount we will get. Then the determination of the NPV. Okay, net present value. What is the net present value of that? So the difference between the present value of cash inflow and the present value of cash inflow, that is the NPV. And in NPV is used to capital budgeting to analyze the profitability of the project investment. Positive NPV indicate that project earning the generated by the investment exceed the anticipated cost. That means if your NPV is greater than the zero, so you have to what? You have to accept it. If your NPV is less than zero, you have to reject it. So now after you have determined your NPV, so just go with the project selection decision. Okay. So this is a process. So yes, this is a capital budgeting process. First thing that you have to estimate, then the discounting rate. After that, determine the NPV. That means first, second, third, and then after that, last one, the project select and decision. That means D. So the option number A, B, D, C. So this one is right over here. The numbering I have forget it. Yes. So yes, option number 2 is right over here. Clear? Now, the next question, which is in your screen, company is considering the investment in the 5 year. Okay, the project that require and the initial outlays is 32,000. That means your cash outflow is 32 lakh. Okay, the estimated post tax cash inflow in the first year, he will get 6 lakh. in the first year. In the second year, he'll get 11. So how much? In the 17 lakh. In the third year, he will get 20 lakhs. So how much he get? 37. But how much we need? 32. So so how much in the 17? How many we add to 15 lakh if we add? So I will get 32. Okay. So what do you have to do? There is a third 15 lakh I need. But actually in the third year, what I have get? 20 lakh. And so here what we want, we multiply with the 12 because we are calculating in months. That's why I have to multiply it. So 5 threes are and 5 fours are, then 5 4 threes are 12, so 3 3 9. So that's why this is a 2 year. Yes, this 2 years. So the 2 year plus this 3 threes are 9 plus 9 month. Okay, so the 2 month 2 year, this 2 year full. Okay, 6 lakhs is added 1 year. In the second year 11, that is we will get in the second year. In the second year we will get 17 lakh. In the third year we are getting what we are getting, that is 20 lakh. But what we have with what how much we need? We need only 15 lakh. So we are not taking whole years, we are just taking 2 year as a whole and the 9 month as a. Okay, so here is 2 year 9 months. So option number A is right over here. This is a simple question. Yes. The next question, the capital structure and the leverage decision come in the ambit with. So you know that the capital structure we have already seen in the last lecture, also in the previous question also, that is capital structure and leverage having the what kind of relation, what kind of decision they have. So actually the capital structure is related to your investment decision. No. Distribution? No. Finance? I don't know. Dividend? No. So what is it? When we read about the capital structuring, we have seen that how much capital from where we need a capital. The capital means we are deciding about, we are concerned about our financing. And what about financing decision? Okay, so these actually what in this actually what this is nothing but your capital structure, and your financial structure is nothing but your financial decision. Okay, so the option number 3 is right over here. Clear? So here you can see that in the financial management having the investment decision, financial decision, and the dividend decision. This is a financial management. In the financial management, there is an, I'm just going to rough it, then you will understand this. Okay. So here, what they having the 3 decision. The first decision they have to make investment decision. Second decision, how to finance that, what you financed it, and where to invest it, and whatever how to pay the dividend. Okay, these are the major concern, major questions they having in their mind. So in the investment decision, they are more concerned about the capital budgeting and the working capital, because they are investing. Okay, and in the financing, what they're about, they're concerned about their cost of capital, how much cost of capital we have to pay, because it is a question of financing. Then the capital structure decision and the leverage. So the capital structure and the leverage, it is a part of your finance decision. Now let's see, the dividend decision is your dividend policy and the retained earning. Clear? So that's why the option number 3 is right over here. Okay, and the dividend, why the dividend having the retained earning? Because the dividend policy, in the dividend policy you can say either you 100% pay out your pay the dividend, either you have to retain the 100% of the profit for your future growth of the organization. So that's why the dividend policy and the retained earning, because they both are depend on the profit of the company. Okay, whatever the profit, whatever the earning is of the company. Clear? Yes. Now the next question. Uh, yes. In the next question, the list is given. Just read it this question and try it with yourself. List number 1 is given. List number 2 is given. Okay. So the list number 1 is mezzanine capital. private equity, okay, and then after your global depository receipt, okay, then after venture capital, okay, then after your venture capital. So if you don't know, you know that what is your venture capital. Venture capital, whatever the capital, we have already seen our lecture, we have already seen. If you're a teen, if you're my student, you know with the venture capital. Venture capital, the capital which is needed in the initial stage or for the new formation of the company, that is a where that is your venture capital, okay. So in the venture capital is a long-term capital embraced by the high network and the high risk appetite of the investor, because they are initially using this capital. Okay, that's why they having the high risk with in case of investor also, and the high network also. Sorry. Now the next one, uh, which is your private equity. So you know that is your private equity. It is it is the word is private, as you say, it is a speedily source of finance, less regulated by the regulator environment on the debt on the capital. Less regulated because in the private they having the less regulation of the capital market. Okay, that's why this is a private equity. Clear? So the option number D is 2. Yes. And option number B is 1. B is 1. Yes, so the option number C is right over here. Okay, so the option number C is right over here. And you know that that is a global depository, that is your GDR, global depository receipt. It is the equity instrument issue in the overseas market globally, okay. It is listed to the trade on the bros on the OTC basis. So this is your global depository receipt. What is a mezzanine capital? So the mezzanine capital, it is refers to the subordinate debt or the preferred equity that allows the firms to borrow the additional willings to finance through the bank loan, okay. So this is the option number C is right over here. Clear? So you can see over here, that is what is a mezzanine financing. Mezzanine financing, it is a capital source between the senior debt and equity. Maximum total leverage with with a little to no equity dilution. Okay, dilution, and the fixed interest rate with a no amortization. So this is a mezzanine financing. And then what is here you can see, in there is an debt and the second lane and the subordinate. These are the unit rate financing. It is a unit rate financing. And second lane, subordinates and the preferred. So the preferred stock, this is a mezzanine financing. Okay, this is a mezzanine financing. Common stock having their different, you know, that is a common stock. So simply that is your equity. Okay, common stock. Okay, so this is your, when you're talking about the senior debt. Okay, so it is a unitized financing with the second lien and the subordinate. And when you are added with the preferred stock with your subordinate and second lien, so it is a mezzanine financing. Clear? What is a GDR? And here you know that there is an in the upper side they are having the, in this upper side they are having the low risk and low return. But in when you are going to the common stock, there is a high risk and the high return. It's depend. Now, what is GDR? GDR is a when global depository receipt. So in the global depository receipt, the domestic custodian and of the equity shareholder, okay, they go to the overseas depository. Okay, that is a globally anywhere. So this is the global depository receipt. Clear? So thank you so much. We have completed over here many questions. So if you have any doubt, just ask me in the comment box. I will be there for you. Okay. Thank you